Hey everyone, welcome back to Corporate Decoder. Tony just filed an 8K reporting on a significant new debt issuance, and I am looking at one crucial detail that might impact investors. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing walks us through how the company is raising money through debt, and it highlights a key aspect of their funding strategy that investors need to understand. Alright, so we are looking at a filing from Federal Home Loan Bank of New York, or FHLB New York for short. They file what's called a Form 8, which is a report for current events that are important to shareholders. The main event here happened on the 7th of July, 2026. Now, FHLB New York is not your typical publicly traded company. It's a federally chartered corporation and part of a network of banks created to support housing finance. They operate in the financial world, and like many financial institutions, they need a lot of cash to do their work. Their phone number is 212-441-6616 if you are curious, but frankly, that is not the juicy part of this filing for us. The core of this filing is about how FHLB New York raises money. They get most of their funds by selling debt securities. Think of these as IOUs that they promise to pay back with interest. They call these consolidated obligations, and they come in two flavors, bonds and discount notes. Now here is an important detail. These consolidated obligations are not just the responsibility of FHLB New York. They are actually the joint and several obligations of all 11 federal home loan banks. This means if one bank can't pay, the others have to step in. It's like a financial safety net within the system. But also means that the financial health of all 11 banks is interconnected. These debts are regulated by the finance agency, and they can even make any of these banks pay for another's debt. This is a critical point for investors to understand. While the federal home loan banks are government-sponsored enterprises, their debt is not guaranteed by the US government. So the backing comes solely from the assets and resources of these 11 banks. The filing then points us to something called Schedule A. This schedule is supposed to list all the major debt offerings planned by FHLB New York. They don't list every single short-term borrowing, but rather the bigger chunks of debt, especially those that will take more than a year to mature. They also will list any debts they take over from other federal home loan banks. This is where things get a bit technical, but the takeaway is important. Schedule A focuses purely on the debt itself. It doesn't include other financial tools they might use like interest rate swaps. These are complex financial instruments that banks use to manage risk, like making sure they don't lose money if interest rates change drastically. This filing doesn't give us insight into that part of their strategy, which is something to keep in mind when evaluating their overall financial picture. And here is another key limitation of Schedule A for investors. It won't give you the full picture of their total debt load. It leaves out short-term debt and doesn't tell you if this new debt is just to replace old debts that are coming due. You can't just look at Schedule A to see if their total debt is growing or shrinking. For that, you would need to look at their regular financial reports, like their quarterly or annual filings. Finally, the amounts listed on Schedule A are what they call the par value. This is essentially the face value of the debt. It might not be the exact same number that shows up on their official financial statements. That is because their financial statements account for things like discounts or premiums when they sell the debt, which are not shown on this basic schedule. So, while it is a good indicator, it is not the final word on the actual value that hits their books. The filing concludes by listing the exhibits included. The main exhibit here is Exhibit 99.1, which is Schedule A itself, containing that important information about consolidated obligations. And this report is signed by Diane Rothstein, who is the Director of Investment and Portfolio Management for FHLB New York. So, what does all this mean for us? FHLB New York functions by borrowing money from the public markets and then lending it out, primarily for housing. This filing tells us they are continuing to do just that. Issuing new debt. The fact that these debts are jointly shared across all 11 FHLB banks is a strong sign of their industry, wide reliance and risk sharing. What I'm actually looking for is the detail on the specific amounts listed in Schedule A, which are provided in the exhibit. This filing is primarily informational, detailing their ongoing funding strategy rather than announcing a dramatically new direction or a problem. It's about the plumbing of their business. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.